This is a live look at the New York Stock Exchange. So about 40 minutes ago, we showed you that the market was actually in positive territory after beginning the trading day down almost 3%. Now we're almost back down to where we started as the volatility continues, which we can expect over the course of the next couple of hours on the trading day. Now, what's important to take a look at is the VIX, the volatility index. That's an important indicator which measures volatility and the mood and the sentiment on the street. It is at times has been as high as 50. Normally we see it below 40. So that gives you a sense of how things are expected to play out over the next couple of hours. So stick with CBS News 24/7. We'll obviously bring you market updates throughout the course of the day, not just during this hour that you and I are sharing together. But meanwhile, let's continue with talking about the economy, specifically as it relates to oil prices, which have been dipping following the economic fallout from President Trump's latest round of tariffs. Falling prices will change prices at the pump, but could also put a squeeze on U.S. oil production and jobs. So I want to bring in Helima Croft, who is the global head of commodity strategy at RBC Capital Markets, to break it all down for us. Always great to see you. So let's talk about these prices. That they're coming down, but that could translate into lower gas prices. That's a possibility. But it's not good news for consumers as well, even if you don't own a car. Explain that.
Well, certainly lower, gasoline prices is good for the consumer, but you have to ask why prices are coming down. And prices are coming down because there's a fear of a massive recession and concerns about the demand impact of a trade war. So this is not because of healthy economic indicators that prices are coming down. Also, at the same time, you have the OPEC countries saying that come May, they may be bringing more production on the market. So we are concerned about an oversupplied market at this time. So yes, for the US consumer, you could be potentially paying in the $2 range for gasoline prices if it continues at this level trend. But the other important factor is US energy companies are going to struggle in this price environment. And President Trump has talked a lot about unleashing US production. And certainly for the all important US shale producers, these are not prices that make it economic to continue drilling at these levels.
So despite the outlook, OPEC is increasing production. How could that impact prices?
It's sort of similar to what we saw in March of 2020. Remember, we were very concerned about the COVID pandemic. It was the early days. It would turn out to be the biggest demand collapse in history. And at the same time, you had Russia and Saudi go into a price war and put more oil on the market. This time, we don't have a full-on price war, but OPEC has said we have several countries that are not abiding by their production quotas. If they don't get their act together, we will be bringing forward more production come May. So kind of a warning to countries that they have to get their act together. But it's really causing concern, again, about having an oversupplied market at the time when everyone is very concerned about fragile demand. And people are watching very closely the tariff impact on China. China is the driver of oil demand growth. So really people will be focused on, is this trade war going to lead to a serious contraction in demand in the all-important Chinese market?
Helima Croft, always great to have you break down complicated subjects for us like this one. We appreciate it.